Well, good evening. If you're joining us remotely, we're going to be taking a look tonight, first at our Chapter 1 homework and then Chapter 2 homework, both quite short. Then we'll be talking about Chapter 3. So let's go ahead here and take a look at Chapter 1 homework on page 18. And we had two different types of questions here in Chapter 1. First of all, some basic review questions, and then we had some multiple choice questions. So with review questions, I normally just go over those on an as-needed basis. Most are very simple, so they don't require a lot of explanation. So I just take requests on them. And then we have multiple choice. So I do go over all those automatically. We don't have any of the discussion cases and problems in Chapter 1, so we will in Chapter 2 then. Let me go ahead here and, excuse me, take a look at Chapter 1. And for those of you watching remotely, I'm going to go ahead and share my screen here. So you can see the textbook. So again, here are review questions. Does anybody have any questions on any of them? All right. Let's go ahead and take a look at multiple choice questions. And the multiple choice questions come from old CPA exams. So with these, we always go over all of them, like I said, and it's very good that we do that, not only so that you know the underlying information, but so that you see how the CPA exam asks multiple choice questions. Multiple choice questions, quite frankly, are the biggest test-taking problem that people tend to have. So it's very important that we go over them. We see the patterns they ask. We see the common reasons why answers are right, why wrong answers are wrong, the types of traps they try to lead us into. So I think you'll find this to be very good for building multiple choice test taking strategy. So here in Chapter 1, as we know, we're looking at this, just an introductory chapter, the demand for audit and assurance services. So all these questions will tie into that theme. So here with multiple choice questions, first one that we've got, well, it's a set of 3, number 12. And the following questions deal with audits by CPA firms and choose the best response. So as we go through here, we'll see, well, sometimes a couple of answers, or even 3 or 4 answers sometimes, have an element of truth though. So they can be really tempting to pick, but the really difficult part is picking which one's better answer. By the way, we're going to find oftentimes the better answer is the one which is more inclusive. We'll see some other patterns too. But always remember that multiple choice questions in general, not only in auditing, but always go for the more inclusive answer. Just make sure all parts of it are right. The 2 answers are right, but one's more inclusive. Big hit. Now, for some reason, they number these sets of questions, and then what are the questions and number the responses. Okay, on CPA exam, multiple choice questions are numbered, and then the responses are A, B, C, and D. So I wish this book had done it. Oh, well. So let's take a look here at the first one. Which of the following best describes why an independent auditor is asked to express opinion on the fair presentation of financial statements? Which one did you say? The answers. Okay. Well, 3, good. It is 3. The objective of an independent party is needed because company may not be objective with respect to its own financial statements, That's true. A company prepares those financial statements, or at least their financial accountants do, and we know that those financials can be biased. That's where we come in. We're an independent party coming from a CPA firm, and we gather and evaluate evidence to see if those financial statements are okay. Then, in B, which of the following professional services is an attestation engagement? Which one did you say? It is. It's 2. An engagement to report in compliance with statutory requirements. We have not seen that yet. We will later in the class. But in all attestation engagements, we're giving an opinion about something. So our professional independent opinion, and it will result in a written report. But all these others do not give our opinion on something. That's why. Then C, which of the following attributes is likely to be unique to the audit work of CPAs as compared to the work performed by practitioners of other professions? Which one did you say? 1, very good. Independence. That's true. Daphne. Well, then number 13. So the following questions deal with types of audits and auditors. And again, choose the best response here. Okay. So here in A, operational audits generally been conducted by internal auditors and governmental audit agencies, but may be performed by CPAs. And the primary purpose of an operational audit is to provide, any idea? Well, 2, good. A measure of management performance and meeting organizational goals. We won't get into operational audits to any extent, but just know what they are. And B, this one might be a little bit difficult. Again, I'm not too concerned about it, but which of the following best describes the operational audit? And as far as the operational audit goes, which one might work? Yeah, 4, good. Concentrates on seeking aspects of operations and which waste can be reduced by the introduction of controls. And finally, there in C, compliance auditing often extends beyond audits leading to the expression of opinions on the fairness of presentation. A financial presentation includes audits of efficiency, economy, effectiveness, as well as 2, very good. Adherence to specific rules or procedures. Questions on any of the multiple choice? Or anything else in chapter 1 for that matter? All righty. Well, that takes care of the homework there. And let's go over to chapter 2 about CPA profession. We know that we're mainly looking at authoritative guidance there. And homework starts on page 41 with some review questions. So let me just go ahead, flip over there. There we go. So a few review questions here. Let's see if there's anything to go over. I don't think anything's too involved, but do you have any questions on any of the review questions? Anything I can go over with you? All righty. Let's take a look at the multiple choice questions then. Well, first, number 13, dealing with auditing standards. So with this, the first one in A, A very common question that is on the CPA exam a lot. In fact, they repeat a lot of questions. So that's why it's good for us to go over all these in the homework, one of the many reasons I should say. So first, which the following best describes what is meant by U.S. auditing standards? Any idea? Okay. This one may not seem as obvious at first blush, but this will always be the correct answer. Number 2 measures the quality of the auditor's performance. So when you think about it, yeah, if our performance is up to standard, it's of high quality. So on CPA exam, yes, indeed, this will always be the right answer. And even though it doesn't seem too obvious, it will be. So as long as you know it, you can always get this one correct. And if you get it correct, well, there's 1 point on your way to the magical 75, because at 75, then you do what? Pass, you bet. 74, you don't. I know you fail. So this might just be that 1 point between success and failure. I've had a few students who have gotten 74s, 73s, and it's heartbreaking. Well, then in B, the responsibilities principle underlying AICPA auditing standards includes the requirement that, okay, actually, it's not the responsibilities section, but it is something we should do. Other ideas? It's 3. So professional judgment be exercised by the auditor. And it's really kind of picky. Expect you to know which group of the standards that comes from. Instead, if you just know the content of the standards in general, you should be okay. I don't think they're going to ask that. Not having you group it. And C, what is the general character? The responsibilities characterized by the performance principles. And what would that be? Okay, it's 3. Criteria of audit planning and evidence gathering. Then, in 14, concerning quality control standards. Well, first, the nature and extent of a CPA firm's quality control policies and procedures will depend on which one. With all of them, exactly. Good. CPA firm size, the nature of the CPA firm's practice, and cost-benefit considerations. You bet, all those. Now, this type of response pattern is common on the CPA exam. So essentially a little series of extended true-false questions. And if in doubt in one of these, which one do you think you should pick? Which pattern of responses? All of them. You got it. So number 1. And if you don't go for that, if it's an educated guess not to go with it, your next most common answer will be which one all the way across? No. So first, yes, all the way across. Second, no, all the way across. This one doesn't have no all the way across, but very often it will. Then B, which the following are elements of CPA firm's quality control that should be considered in establishing its quality control policies and procedures? Well, pretty safe bet. It's which one? All of them, you betcha. Number 2. So yes, we should think about human resources, our employees. Think about monitoring. Think about engagement performance. 2, do the trick. And C, one of the CPA firm's basic objective is to provide, professional services that conform with professional standards. Reasonable assurance of, of achieving this objective is provided through which one? That one's too narrow. It's correct, but it doesn't include everything. One, good. A system of quality control. Because a system of quality control is going to make sure that all these other three are followed. The other three are correct. Definitely things CPA firms should do. But can you see why number one is more inclusive? Okay. So it's more inclusive, it includes the others, and definitely we'll go with that more inclusive answer. It's always the better one. Very common pattern. So any questions there on multiple choice? Okay, let me turn to page 45. We had one case. And that was number 20. So we've got this little case here. Before I go into it, let me just see what's required. Always a good idea so that we know what we're looking for. So we're going to briefly describe each of the principles underlying AICPA auditing standards and indicate how the action or actions of Holmes as the CPA result in a failure to comply with each principle. So we organize our answers as follows: brief description of the principle, Holmes' actions resulting in failure to comply with the principle. I'll actually go through the case and pick out the wrong things Holmes is doing. And then I'll describe how this violates the principles. So that way you don't have to list these principles like a memory task. They certainly would not have you do that on the CPA exam. We see here from the footnote that that is based on this AICPA question paper. So again, it's an old CPA exam question. Let's come up to the top. We see that Ray, the owner of a small company, asked Holmes, the CPA, to conduct an audit of the company's records. Now, this was not the official answer, but there's something in that first sentence I really don't like. What looks wrong? Like not such a good idea. What do we audit? Financial statements. And what is Holmes concentrating on auditing? Company's records. Yeah, not such a good idea. Because even though those underlying records may be okay, we need to make sure that they were compiled into financial statements properly, including footnote disclosure. So that's not such a great thing. So we shouldn't be auditing just company's records because we're told that we should audit financial statements. In fact, taken as a whole. So we're supposed to audit everything together. We'll deal more with that here tonight in chapter 3. Then Ray told Holmes that an audit must be completed in time to submit audit financial statements to a bank as part of a loan application. That sounds just fine. Common reason for being audited. It's obvious that this is a private company. The SEC does not say you must have an audit because it's not under the SEC's authority here. It's not publicly traded. But financial statements, submit them to a bank as a part of a loan application, very common. That's fun. Then Holmes immediately accepted the engagement and agreed to provide an auditor's report within 3 weeks. Does that sound so great? No, Holmes doesn't even know what problems he's going to encounter. So there's no way that Holmes can give this assurance of being done that quickly if he doesn't know what problems might be. He hasn't looked things over. So that is not proper audit planning. It just isn't. Some problems there, and we don't get done that quickly. Ray agreed to pay Holmes a fixed fee plus a bonus that the loan was granted. Well, two things wrong there. One, from an auditing standpoint, fixed fee plus a bonus. What about that bonus? I'm sorry, go ahead. Precisely. You summed it up very well. It gives them that best interest to say everything's fine because Holmes is going to want that bonus, also known as type contingent. Now remember in auditing, we can never accept a contingent fee because that takes away our objectivity right away. It makes us biased. So we're going to say, sure, everything's fine. That's not good. We sure can't do it. Violation of independence. There's something else wrong in that sentence, and it's not from an auditing standpoint. It's grammatical. Just shows that we're very good auditors here. What's grammatically wrong? No. If you've ever conjugated a Romance language, you've dealt with the subjunctive mood. And it's present in English as well, but it's not taught to any great extent in English classes. It's too bad because people make this type of mistake all the time. So instead of saying if the loan was granted, we would say if the loan this was okay. Actually were. The subjunctive mood. It's something that might happen. So just little things like that are really good to know so that people know that you've got good grammar and therefore you know what you're talking about. So after all, we're accountants, we're educated, people like good grammar from us, even though we don't deal with numbers. Then Holmes hired 2 accounting students to conduct the audit and spent several hours telling them exactly what to do. How do you feel about that sentence? Yeah, I hired the 2 accounting students to conduct the audit, spent several hours telling them exactly what to do. We're going to see that he just turns them loose. Well, it's okay to hire them as assistants as long as you supervise them and make sure they do everything okay. But not just to turn them loose without proper supervision, because they're not yet CPAs. They don't yet have all of the experience and education that they really need. As far as spending several hours telling them exactly what to do, that's nice, but still that's not proper planning and supervision. It just isn't. So he's not doing this on himself. Then Holmes told the students not to spend time reviewing internal controls, but instead to concentrate on improving the mathematical accuracy of the ledger accounts and summarizing the data in the accounting records that supported Ray's financial statements. So don't review internal control. Instead, just check this mathematical accuracy. Does that sound like an audit? No, it's not. This is not gathering proper audit evidence. It just isn't. Instead, this sounds like another type of engagement that we just briefly mentioned in chapter 2. And does anybody remember the name of that engagement? I said it was a whole lot cheaper than an audit. Compilation, very good. This is compilation. So for that, you can actually let them do it. You actually don't have to be a CPA to do a compilation. But this is not giving assurance on financial statements because we've not gathered any evidence. We're not professionally skeptical. Well, the students followed Holmes' instructions. Good for them. And after 2 weeks, gave Holmes the financial statements, which did not include footnotes. How do you feel about no footnotes? No. We know financial accounting. The GAAP says we must have proper disclosure. But footnote and parenthetic, as it turns out, GAAP says so, we have to do it. Not everything in GAAP is computational certain. Well, I can't think of a set of financial statements which does not include footnotes. So they probably didn't know what they should have done. He should have been supervising it. But definitely footnote disclosures. These are not complete GAAP-based financial statements as a result. Holmes reviewed the statements and prepared an unmodified auditor's report. An unmodified auditor's report means everything's fine. It's a nice, clean opinion that everybody wants. We'll see in chapter 3. Well, the thing is, he doesn't have any basis to issue an audit report. An audit wasn't conducted. So the most he can do is a compilation report, which we'll see in the graduate level auditing class. So not good. Then the report did not refer to generally accepted accounting principles. Again, not good. We will have to refer to GAAP. We'll see that again in chapter 3 with the audit report tonight, or to the consistent application of such principles. In other words, sounds like these students didn't check to see if there had been a change of accounting principle this year, like from LIFO to FIFO for inventory valuation. We have to. And if there has been a change of accounting principle, we must bring it out in the audit report, again, like we'll see in chapter 3. By the way, I hope that this client did not go from FIFO to LIFO for inventory. And why do I say that? I mean, technically they could, but it's not that I did. I didn't think I say that. Yeah. Here's one. Under IFRS, LIFO is not a permitted accounting principle. So we can't use that. That means it's falling out of favor in the United States. And it's forbidden in almost all the rest of the world. LIFO is an American invention. It was invented back in the 1930s during the Great Depression. It's not something that we should be doing. It just isn't favored. We could do it, but again, it's not the best principle to use. Anything else there on that case? Okay. Yes.
Do the other reports go also to the bank, or it's just for the internal use of the company?
It's I'm sorry, the first part is one.
The audit report will go to a bank, or that's just for internal?
It'll go to the bank.
Okay.
Yeah, what will happen is that this client is going to have to file those financial statements of the day with the loan application. And wherever the financial statements go, the report has to go, whether it's an audit report or a compilation report. Anything else so far? All right, certainly, if anything crops up at some point, just let me know. Do you have any questions, Daphne? Are you okay? Okay. Whenever you have questions, just let me know. Feel free to just say something there. I should watch the chat feature better, but I'm not really good at that, to be honest. So it just helps if you get my attention. We're informal here. All righty. Well, here tonight, we're going to cover one chapter of new material, and it's chapter 3 about audit reports. So here with audit reports, we're going to see the end product of the auditor's work. So in other words, we're going to see what happens after all this evidence gathering. I'll share my screen for you here, Daphne. There. We'll see what happens after all this evidence gathered. And the auditor decides whether or not financial statements are okay. It's our primary means of communication to investors, so there sure is a lot of risk attached to it. It's very carefully worded, as we'll see. We're also going to see that here at the audit report, it's good that we've gone over it toward the start of the semester. This way we know where the audit is working toward. We know the end product of the auditor's work. So that way we step back from the audit report and we see how everything fits into place there. Very good way of learning about auditing. Long time ago, most audit professors used to say it until the end of class, and it just didn't make as much sense as if we covered it up front. I know it looks strange covering it up front because it's like, well, why did we start there? But believe it works. Here in chapter 3, this chapter does have a lot of material in it. It's not necessarily that difficult, but there's a lot. And in fact, the most material out of any chapter of the book. So it will take some time to absorb. Once you absorb it, you'll be fine. And I think pretty much you'll be fine as we go through it tonight. There's just a lot of stuff to know. It's very important you learn it though. First, it's going to help you with the rest of the course. It'll help the rest of that course make much more sense. And it's also tested very heavily on the CPA exams, you can guess. And really a third reason is because later we'll see some other types of reports that are based on the audit report. So it really is the basis for a whole lot of what we study. But if you learn this really well, this will help you do very well in the CPA exam. So let's see what we'll do. Well, we'll first talk about the basic audit report. So the so-called unmodified report, so known as standard unqualified report, also known as the clean opinion. It's the one everyone wants. Everything's fine, it says. Then it'll turn our attention to where it's got to be modified. There may be something wrong, or sometimes there's not exactly something wrong, but we still have to bring something out in the audit report. So we'll cover all those situations too. We'll see how that audit report is worded, both when it's just a standard unmodified audit report, and also when we've got to modify it for some reason. So again, all that is done very carefully by the profession, and it's minimized risk to us. So let's see here. Well, if we look here at Roman numeral 1, by the way, the standard unmodified audit report, or unqualified audit report, well, standard unmodified audit report too, and also the clean opinion, all the same thing here. And audit report and audit opinion are used interchangeably in practice because that report really is the auditor's opinion. We've got a summary of what we found through evidence gathering. Are the financial statements okay or not? By the way, this type audit report issued to well over 98% of all audit clients, because clients usually fix whatever's wrong, at least before the auditors complete their field work. Often the audit's a big cleanup act. It may have been a rather messy process to get the clean opinion, but if those financial statements have been corrected, then we can say that they are now okay. Fairly stand in accordance with GAAP in all material respects. So in that case, we can give a clean opinion after this cleanup act, and well, client's facing a big audit bill as well. So whenever we see an audit report that is not unmodified, well, usually that's something the client could not fix. So it just remains, as we'll see. So looking here, how important is it? It's really important. So therefore, again, a lot of risk. The auditor's primary communication to investors, to the SEC for a publicly traded client, to other third parties as well, to creditors. So yes, we're really, really careful here. Now, we'll get into the nitty-gritty of that clean opinion in just a few minutes. But as we have the clean opinion, we always remember this. Even before we read it, it's a signal of certain things. So it signals reasonable assurance, such concepts as the following. In other words, it does not give absolute assurance that these exist. It doesn't give 100% guarantee, but it gives, well, a 90-some-odd% guarantee. In fact, how many things in life are 100% certain? Not many. Nope. So one signal, all of the generally accepted auditing standards, all the SASs are met, and also PCAOB standards have been met for SEC clients. So we followed all the authoritative guidance we should. A second thing, no material scope limitations exist on the auditor's work. A scope limitation is when we cannot examine some evidence we wanted. If it's for a large amount, a material amount that is, then, well, that's going to result in not a clean opinion. If it's for a very small immaterial amount, that's okay. Not big enough to worry about. By the way, how many clients do you think might have very small scope limitations? All of them. Totally agree. For example, a receipt doesn't exist for a low purchase. No big deal. We're not going to hunt for it. Then third, the financial statements do not have a material departure from GAAP, like a material misstatement, a big misstatement of dollars. Now, again, how many clients do you think will have an immaterial departure from GAAP? All of them, you bet. Not worth chasing down, just not big enough. If we tried to correct everything, we'd never get the audit done. And this also means all the financial statements are present. The balance sheet, the income statement, statement of retained earnings, or statement of stockholders' equity, and statement of cash flows. If one of those is missing, that's a violation of GAAP because GAAP says they must all be there. If they're not all there, that's called an incomplete presentation. Can't give a clean opinion. And this also means that the financials have adequate disclosure. If they don't, well, again, we can't give a clean opinion. How many clients do you think would let their financial statements go out the door and not have all those financial statements there and then get something less than a clean audit report? I don't think so. How many clients would get something less than a clean audit report because they just plain old left off a footnote, do you think? No. That would be a very dumb thing to do. Then fourth, the auditor is independent of the client. Otherwise, we shouldn't even be there doing the audit. Must be independent to do an audit. And the client has sufficient internal control and integrity to permit an audit. If they're too messed up to have those, we should not be in there accepting them as a client. And we'll see in chapter 8 how we screen clients before we do accept them. So we should have detected these things. And in a moment, I'm going to be going to page 48. It's going to illustrate the standard unqualified audit report. And we're going to note some sections. Let me take a look at the first 3 sections here, then go to the page and kind of flip back and forth. So one, we'll see it's entitled Independent Auditor's Report, or maybe Report of Independent Accountants or Independent Certified Public Accountants, but something that includes the word independence in there. And then we'll see that's addressed to the client stockholders preferable. May also be the board of directors, it may just be a company, that's okay. It should not be addressed to management. It should not be addressed to anyone that works for the company, in other words, because that would make us biased. They're biased. We don't want to give the semblance, so we report to a biased party. And then third, the introductory paragraph. It's going to be a factual statement about the audit. So with those things in mind, let me turn to page 48. So here it is in figure 3.1, standard unmodified audit report or audit opinion report on comparative statements for a U.S. non-public company. So looking at that, comparative financial statements means more than 1 year present alongside each other so that somebody can compare 1 year to the other. We'll see that the audit report has to touch on each of these years, has to mention each of the years. And it's for a non-public entity. So that means not publicly traded, it's privately held. So the SEC is not involved. So we're using AICPA auditing standards, our authoritative guidance. If we're publicly traded, it would be mentioned that we're using PCAOB standards instead, even though they're pretty much the same. Well, we take a look here. This is on CPA firm's letterhead. It's not absolutely necessary to do that, but it's a good idea. Then, as we go through this audit report, what this CPA firm here has done is that they've used audit software to prepare this. And there are many audit software packages out there. Each national CPA firm has its own, and there are a few top audit programs. And one of the top is called PPC. I forget what PPC stands for, another acronym. But this has been prepared using PPC software, just to kind of let you know. What happens is that you would access a template and just custom make that to your client. And audit software has a lot of other things too that we can access, such as working papers where we can document the evidence we get. We'll see a lot of that as we go through the course. So, independent auditor's report, and it's in there. The address is to the board of directors and stockholders, General Ring Corporation. Sometimes we see board of directors, there are 2, often stockholders, or often, as I said, just company. That's okay, but definitely not to management. Now, this introductory paragraph, very short. You don't have to memorize the exact wording, certainly nothing like that. You would not need to in practice either, thanks to all the software. But instead, I would just expect you to know the content. Same thing on the CPAs. So it says here, we have audited the accounting balance sheets of General Ring Corporation as of December 31st. 2 years are mentioned there. The related statements of income, changes in stockholders' equity and cash flows for the years it ended, and the related notes of financial statements. So usually this starts off by mentioning balance sheet and then the other financial statements. The reason is that the balance sheet is the most basic financial statement. Those are real accounts. They carry over from one year to the next. The other financial statements tie back into the balance sheet. So that's generally just there by convention. We mention each year presented because we must touch on every single year financial statements presented. We've also audited the notes. So we make sure that disclosures adequate. Now, we'll see management's responsibility coming up next. Let's take a look here at management's responsibility. Back to the book. I'm sorry. Notes, I should say. So number 4 here about management's responsibility for the financial statements. And this section is important because it emphasizes management's responsibilities so that the auditor is not held accountable for them. Management is the one that's responsible for preparing financial statements, for maintaining internal control, not the auditor. People think the auditor is. We try and make it clear here, the auditor is not. I'll show you. And audit reports refer to United States GAAP in this section. That is the authoritative guidance for use. However, for SEC clients, publicly traded ones says, PCAOB's auditing standard number 1 requires the GAS be replaced with the standards of the PCAOB. That's how we can always tell the difference here. So let's come back here to the book. Management's responsibility for the financial statements. Well, management is responsible for the preparation and presentation of the financial statements in accordance with accounting principles generally accepted in the United States of America. There's US GAAP. It is truly a truly is a non-publicly traded client. Well, this includes the design and implementation and maintenance of internal control relevant to the preparation and presentation, fair presentation of the financial statements are free from material misstatement, whether due to fraud or error. So we are looking for material misstatements. It could be fraudulent. Somebody meant to do it. Somebody meant to cook the books. Or it could be error. Nobody meant to make it, but they may have posted error. Or a mathematical error, or a software error. It's kind of like oops. Well, then we'll have the auditor's responsibility coming up next, including something called scope paragraph. Let's see. Well, I have the notes first, then we'll come back to the book. So number 5 there, auditor's responsibility. Well, this section contains the auditor's responsibilities for the engagement, so what we have to do. And 3 paragraphs. The middle paragraph, this is the scope paragraph. And that's factual statement about what takes place in the audit. So the scope of our work, what we do. And note this term, this section rather, includes the term reasonable assurance, which means the auditor will not perform a procedure unless benefits exceed the costs. And that's in contrast to absolute assurance, which would involve investigating everything. So we only give reasonable assurance. We don't give 100% guarantee again. We would not do something, some procedure, unless it were worth it. That's a part of it. Now, for an idea of the expectation gap between the auditing profession and the general public, consider the point of view of each. Well, as an auditor, we know that we can't do everything. But what do you think the general public tends to think? We should do everything. So try and make it clear that we just can't. Let's come back to the book and have a look at this. Auditor's responsibility. Well, our responsibility is to express an opinion on these financial statements based on our audits. That's pretty basic. We conducted our audits in accordance with auditing standards generally accepted in the United States of America. And those standards require that we plan and perform the audit to obtain reasonable assurance, there's that term again, about whether the financial statements are free of material misstatement. So we only give reasonable assurance, not 100% guarantee. We're only looking at material misstatement. So we're softening things a little bit by saying reasonable assurance and material misstatement. Otherwise, if we didn't say these things, we'd be responsible for finding everything. So we give ourselves some wiggle room. Then, scope paragraph. Well, an audit involves performing procedures to obtain audit evidence about the amounts of disclosures in the financial statements. So a big evidence gathering process. Those standards selected depend on the auditor's judgment, including the assessment of the risk of material misstatement of the financial statements, whether due to fraud or error. And again, fraud, someone meant to do it. They're cooking the books. Error, they didn't mean to. And making these risk assessments, the auditor considers internal control relevant to the entity's preparation and fair presentation of the financial statements in order to design audit procedures that are appropriate in circumstances, but not for the purpose of expressing an opinion on the effectiveness of the entity's internal control. Accordingly, we do not express such an opinion. I'll tell you, for our publicly traded companies, we'll see later in the chapter, we must express an opinion about internal control. It's like two audits in one. But for a non-public company like this one, we don't. And all it also includes evaluating the effectiveness of accounting policies used and the reasonableness of significant accounting estimates made by management, as well as evaluating the overall presentation of the financial statements. So we look at accounting policies. Maybe we feel that FIFO is better than LIFO, we would so state. And also any estimates management's made, like number of years useful life or an asset for depreciation or the residual value. We just evaluate that and make sure that we feel it's okay. We agree. Well, we believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for our audit opinion. Good. Then finally, we have the auditor's opinion paragraph. So let me just have a look at that here in my notes. So number 6 there, the opinion section. Well, this gives the auditor's conclusions about whether the client's financial statements are fairly stated in accordance with GAAP. And we'll note design includes such terms as certify, correctness, accuracy, freedom for error, fraud, etc. Then years ago it used to, but not today. Those are too absolute in nature. No wiggle room there for us. So instead, we're going to use such terms as fairly presented in accordance with GAAP, reasonable assurance, material, test basis. It means that we sample. We might miss something because of that. I'll show you that in a second. And in the United States, it appears to the end to emphasize that American GAAP is being used. And let me just look at 7 and 8 before I go back to the book. We'll see in 7, the name of the accounting firm should be on there. And ideally it's signed. Not always, but ideally it is. And it should also include the city and state of the CPA. And then number 8, we'll see the report date. Stand on the at the end of all that work, which can affect the opinion. And the report is also that limited the auditor's responsibility to search for subsequent events. We'll see that in chapter 24. Thus, the auditor believes the financial statements are fairly stated as of this date. If he or she issues a clean opinion. So let's flip back here in the book. Here's the opinion paragraph. So in the opinion, well, in our opinion, the financial statements referred to above present fairly that there's that term again in all material respects, materiality again, the financial position of General Ring Corporation. So paralleling the balance sheet up above, as of there are the dates again. Said that nobody can be coached by an attorney and say they were confused. Lock things down carefully. And the results of their operations, paralleling the income statement and statement of retained earnings and cash flows, paralleling obviously the statement of cash flows for the years that ended, once again, just being careful, in accordance with accounting principles generally accepted in the United States of America, so US GAAP. Then we see, sure enough, this has been signed. And again, sometimes that's just plain typed, but preferably it's signed. And it used to bother me, who signs this? Well, the answer is just anybody with good writing. And there's the city, Denver. So the audit report date, the date the auditors obtained sufficient appropriate evidence. And that's February 15th. So it's a month and a half after fiscal year end. That's okay. There's usually some time. And in fact, I should say there always is, because there's no way that we can get the audit done right as of the last day of the fiscal year. It's always sometime late. So that's the auditor's limit to look for more evidence, to search for things that happen after fiscal year end but affect that previous fiscal year. Those things that happen in the early part of next year are called subsequent events. Yet warrant them far later in the course. So what questions do you have there on the audit report? Okay. Does it seem fairly easy to understand? You think? Yeah, I think it is. Just quite a bit of material. But again, you're not going to have to write that thing out, either on my exam or on the CPA exam. So don't worry about that extent. Understand the content instead. Well, see, we've already looked at additional details, the report there in the text. Well, let's talk about a few other things that tie into this clean opinion. Here in D. Well, the clean opinion says that the auditor provides reasonable assurance that there are no material departures from GAAP. Again, we've softened those terms, we admit. Don't want to lock ourselves down. Also, no material scope limitations. Thus, there are going to be immaterial departures or limitations. There will be for, I could really see every client, just like we were saying earlier. And in fact, even material departures from GAAP or material scope limitations may still remain undetected. As the auditor applies reasonable assurance, we do investigate everything, including gathering evidence on a test basis. So we might skip something there because we didn't sample it, but that's an inherent limitation of sampling. It's not our fault. Well, as we'll see throughout the course, if this happens, the auditor will rely on documentation in his or her audit documentation, commonly referred to as working papers. In fact, we'll document everything we possibly can to show that the auditor applied due care and followed proper auditing procedures. We did everything we should, in other words. We can document. Well, a little note here about materiality. In fact, 4 little notes. One is that an item is material if it can change a financial statement or arrears decisions. We know that from financial accounting. And this is a big judgment call. But materiality is usually decided by comparing an amount against some benchmark, against some base, like against net income. And if something is not measurable in monetary terms, it's within scope limitations, then that judgment is even more of a judgment call because we just don't know how much is there. Now, if we remember conservatism, well, do you think that if in doubt, like maybe with the scope limitation, that we should say that something is material or immaterial? If we have to make a choice, an educated guess, which is safer? Say it's material or immaterial? Material. Therefore, we take action on it. Therefore, it must be corrected before we issue a clean audit opinion. Yes. We sure would. That's a very good question. We'll definitely bring it to the client first, client's attention. We'll ask that it be fixed. If they don't fix it, again, that's a really dumb and stubborn client. The most common thing out here that remains unfixed will be the scope limitation. Specifically, a type scope limitation that is imposed by the client. I'm sorry, whoops. The most common thing that is not fixed is a scope limitation, specifically a type scope limitation that is imposed by conditions, like they destroyed some documentation accidentally. There's another type scope limitation that is imposed by the client. The client says you can't see something, some evidence. For that, the client can fix it. They won't even bring that to start with. If they do, they know they'll be in trouble. Anything else so far? Well, then number 2, some things are material due to their nature, regardless of the dollar amount involved. I'll show you a list on page 62 in a moment. We also need to add most related party transactions to this list. And related party transactions, such as major stockholders, senior management, directors, or related companies, are an arm's length and therefore possess high risk. So we don't have 2 parties at normal arm's length that are in adversarial positions. They're negotiating to decide fair market value. Instead, it's not an unbiased transaction like that. It's a biased one because of the relationship with each other. Related party transactions, almost every accounting fraud is involved. So we're really, really careful there. Almost all of them are material as a result. And most have to be disclosed too. So just have to play it really safe there. Most related party transactions, material. Now, as I come to the book and take a look at page 62, here are some other things that are material due to their nature, not by comparing them against some base like net income. Just find, there we go. I'm looking under the nature of the item here. So it says the decision of a user may also be affected by the client misstatement, not just how big it is, not just how it compares to some base like net income. So the following may affect a user's decisions and therefore the auditor's opinion in a different way than most misstatements, again, due to their nature. So first, the transaction which is illegal or fraudulent. That's bad. We check it out. We say to the client, it's got to be corrected or we cannot give you a clean opinion. Second, an item may materially affect some future period, even though it's immaterial when only the current period is considered. So let's say that there is a small software error that we discovered this year. It could even be an error in Excel self.
Hi, I can't hear you.
Muted. Okay, Zoom interrupted on my end and muted itself there. Okay, so you didn't miss anything, right?
Well, you went off for a little bit.
Okay.
Yeah.
Just like less than a minute. Okay, good. Sometimes get a little glitch like that. Let me just make sure I'm still recording here. Good, thanks. Well, number three, an item has a psychic effect. For example, the item changes a small loss to a small profit, maintains a trend of increasing earnings, or shows earnings to exceed analysts' expectations.
Hey, Professor, can you share your screen?
Oh, I'm sorry. It flipped that one off to fix right here. Yeah, reset some of the parameters there. There we go, Daphne.
Thank you.
You betcha. And number four, an item may be important in terms of possible consequences arising from contractual obligations. For example, the effect of failure to comply with a debt restriction or debt covenant may result in a material loan being called. In other words, that client owes back. So whenever debt covenants are getting tight, suddenly any little misstatement resulting related to that debt covenant gets to be material. For example, if one debt covenant is that we must have a current ratio of at least 1.5. Well, if that current ratio is just above 1.5, then suddenly any little misstatement regarding a current asset or a current liability gets to be material. Because even if that current ratio falls just below 1.5 for a brief time, technically that loan could be called. So as an auditor, we say that misstatement is material, it's got to be fixed. Any questions there so far? Right. So here in Roman numeral 2, I'd like for us to start taking a look at when something's wrong and we've got to bring it out in the audit report. So departures from the standard unqualified audit report when something is materially wrong. It could be a departure from GAAP, so there's a misstatement. It could be a scope limitation. The auditor could not examine all the evidence he felt is needed, or lack of independence. The auditor's not independent. that one never happens. Well, in A, again, we always bear in mind that we give this client a chance to correct whatever's wrong. We do that before we actually modify the audit report. If the client corrects everything, that's great. Then the financial statements are fairly stated and no material departure from GAAP or material, excuse me, a material scope limitation exists, at least of which the auditor is aware. We can then issue a clean opinion. That's why almost all audit reports are unqualified. So in B, except for lack of independence, each of these departures will require the addition of the basis for the qualified opinion or the basis for the disclaimer of opinion or the basis for the adverse opinion. We'll see those are really bad, which precedes the opinion section, since the opinion is modified. And we sometimes call this an explanatory paragraph because I'll explain what's wrong. And each of these reports based on the standard unmodified or unqualified audit report. So we'll just concentrate on what is modified. So the first one I'd like to get into is a scope limitation and see what we need to do here. Let me come back here to the book, of course, a moment. Let me look for a little chart I'd like to reference. Bear with me a moment. It's easier for me to look it up in the printed version of the book here, then go to it on the screen. Page 67. Here we go. So we'll see these three conditions: scope restricted, scope limitation, financial statements not prepared in accordance with GAAP, so some misstatement, and finally, the auditor signed independent. This lack of independence is a problem. That's quality control problem. Let's hope it never happens, but anyway. Let me come up here. Oh, my internet connection's unstable. There, that's what holds up. So the first condition again, the scope limitation or scope restriction. It may be restricted by client or by other conditions. So the client can help it. If the client restricts it, says the auditor cannot examine some evidence. But if it's restricted by conditions, like some documentation was accidentally destroyed, the client cannot fix that now. So the client's probably stuck with that. But again, how many clients really want to try to say to the auditor, you cannot examine some evidence? You want to? How good of an idea would that be? I don't think so. Now, 3 levels of materiality. Well, first, something immaterial, not big enough to worry about. Well, that's fine. We issued the standard unmodified opinion that we saw. But then, if something gets to be more material, usually because it's bigger in dollars and therefore a bigger percentage of some base like net income, and we'll see different bases in chapter 8. But if it gets bigger, then it gets to be in this in-between level of materiality. Material, but not pervasive to the financial statement as a whole. So not pervading the financial statements, not that highly material. Most things, if they become more than immaterial, they get to this in-between level. Here's what we do. We would have this additional paragraph in the audit report, that explanatory paragraph, describe what's wrong, and we'll qualify the opinion with the term except for. But then let's say this gets bigger still, a bigger chunk, therefore, of the financial statements. Well, that's so material that overall fairness is in question. That's referred to as being highly material or pervasively material. It's pervading the financial statements. In that case, we'll give what's called a disclaimer of opinion, and it's not good. So let's come back to the notes. Just a few minutes. Let's look at C. Well, scope limitation, as we know, may result either from conditions, such as when source documents have been destroyed in a fire, or from the client, such as when management refuses to allow the auditor to examine some needed evidence. Again, that's bad. Of course, note the former is the more common scope limitation because client cannot help it. Well, a scope limitation will cause the auditor to either issue a disclaimer of opinion, as we saw, if it's highly or pervasively material, or a qualified report if it's in between materiality. And it's often hard to decide upon materiality for scope limitations and for departures from GAAP. That's because we don't necessarily know how many dollars are involved, since we cannot conduct all the audit procedures we felt we needed. So if in doubt, we're more quickly apt to decide, as we know, as we covered a few minutes ago, that something is highly material. Therefore, the worst case scenario in the audit report, which would be a disclaimer. And by the way, also note that we will be especially quick to decide that a client imposed scope limitation is highly material. In fact, the auditor may instead withdraw at this point, especially if he or she appealed to higher levels of management and did not obtain a satisfactory resolution. Because after all, if management's saying you cannot examine something, well, it sounds like they might just have something to do what? Hide, you bet. So we'll see examples for both types of reports in just a moment on page 64. We're going to note, let me take a look at the first two notes, then I'll go to the page. Well, in both reports, the section of the basis for the qualifier or disclaimer of opinion precedes the opinion section. So the explanatory paragraph will go before the opinion. That way, the reader reads down through this explanatory paragraph and they know what's wrong by the time they get the opinion. Then, second, in the qualified report, the last sentence of the auditor's responsibilities section is changed to reference the qualified opinion. The opinion is qualified with the phrase except, and the rest the same as in the standard unqualified audit report. Let me go over there. Page 64. Have a look at this type of report. There we go. Figure 3A, qualified opinion due to scope restriction. Now, this report here is for the in-between level of materiality. So, we know that because it's not a disclaimer. So independent auditor's report, same as before, and then the same introductory paragraph, manager's responsibility paragraph, and first two auditors' responsibility paragraphs as in the standard report. So we're familiar with that. Then that last little bitty paragraph has changed just a bit. It says, we believe that the audit evidence we've obtained is sufficient, so we have enough, and appropriate, it's high quality, to provide a basis for our qualified audit opinion. So we just add in the term qualified. Then we add in this explanatory paragraph, the basis for why we gave that qualified opinion. Again, it goes before the opinion paragraph. This way the reader will read down through this problem and know what's wrong by the time they get to that qualified opinion paragraph, and they know why it's qualified now. So let's see what's wrong. Well, Laughlin Corporation's investment in XYZ Company, a foreign affiliate acquired during the year and accounted for under the equity method. Don't worry about that. You'll see it in advanced financial account. Is carried at $2.4 million on the balance sheet at December 31st, and Laughlin's share of XYZ Company's net income of $365,000 is included in Laughlin Corporation's net income for the year then ended. We were unable to obtain sufficient appropriate evidence about the carrying amount of Laughlin Corporation's investment in XYZ Company as of December 31st, 2018, and Laughlin's share of XYZ Company's net income for the year that ended, because we were denied access to the financial information, management, and the auditors of XYZ Company. Consequently, we were unable to determine whether any adjustments to these amounts were necessary. So we could not examine the evidence we want. Management just denied us. So most auditors right now get really, really suspicious. This one did not get extremely suspicious because he did not go with this one. Instead, a qualified opinion. So in our opinion, except for the effects of the matter described in the basis for qualified opinion paragraph, the financial statements referred to above present fairly in all material respects. The financial position of Laughlin Corporation as of December 31st, and the results of operations and its cash flows for the year that ended in conformity with accounting principles generally accepted in the United States of America. So except for that one thing wrong, we think the rest of the financial statements are just fine. Questions there on that? Understand? I know you'll need to go back and review this. Quite a bit of information the chapter throws at you, but trust me, when it clicks, it really will click. Good news. Nothing right. Okay. Then, back on the notes, number 3 that I skipped. Well, in the disclaimer of opinion, the section of the auditor's responsibility is changed in wording and shortened by, excuse me, omitting the last 2 paragraphs. As an effective audit could not be conducted. It's really bad. The introductory paragraph is modified to say we were engaged to audit, instead we audited. And the opinion section is actually a disclaimer opinion. It means we don't give one. Let's see that in the book. Here we go. It's in figure 3.9. Disclaimer opinion due to scope restriction. So, independent auditor's report. The very first part of the first sentence says, not we audited, but we were engaged to audit. The rest is the same. So, in the standard unqualified audit report. Then, the same management's responsibility paragraph is in the standard unqualified audit report. Then the auditor's responsibility paragraph is changed. And it doesn't sound very good. Our responsibility is to express an opinion on these financial statements based on conducting the audit in accordance with auditing standards generally accepted in the United States of America. Well, because the matter described in the basis for disclaimer of opinion paragraph, however, we were unable to obtain sufficient appropriate evidence to provide a basis for an audit opinion. So here's that basis for opinion paragraph added in again. It's the very same thing that we just had in the previous example. But this auditor here is decided as highly or pervasively material. It's really bad. And it could be because this foreign affiliate is a bigger chunk of this client. meaning that the client overall is smaller than the previous audit report we saw. Or it could be this auditor is simply more conservative. And this auditor said, well, if this auditor is not giving me access to the auditors and management of the other company, management's trying to hide something. I'm going to say it's highly or pervasively material and give a disclaimer of opinion. So here's that disclaimer of opinion. So because of the significance of the matter describing the basis for disclaimer of opinion paragraph, just up above, we have not been able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. Accordingly, we do not express an opinion on these financial statements. That's really bad. We can't give an opinion. Well, what do you think the SEC would think of this if this were a publicly traded company? Not much. In fact, they will give this client a chance to correct this. They'll give them so long to fix the situation, obtain another audit, and file something better than a disclaimer of opinion. Otherwise, the SEC is going to say, if you've got problems like that, you don't need to be trading your stock and bonds. We'll make you go dark, which means you can't trade anymore. So there's some serious consequences. These are pretty rare. Any questions there on that? Okay, well, the next thing we'll do here is to go to the departure from GAAP. Let me turn back to page 67 of the book for just a moment before we go through this material in the notes. Go back to this chart that we had. So departure from GAAP is second. So if something's immaterial, that's okay. Too small to worry about. Issue a standard unmodified opinion. If it bumps up to the in-between phase materiality, we'll add the additional paragraph again to explain what's wrong. And we'll qualify the opinion paragraph with except. Then, if materiality gets even greater, well, it's going to bump up to the highly or pervasively material phase. And with that, that's bad. We'll issue what's called an adverse opinion. It says, we believe the financial statements don't conform to GAAP. And trust me, clients don't want that. Let me go back to page 64. Take a look at the report itself. Oh, by the way, make a little note, the figure 3.8 is for the highly or pervasively material phase of the scope restriction. Highly or pervasively material. So now let's come to figure 310. So qualified opinion due to non-GAAP, departure from GAAP. You can make note that this is in the in-between material phase. Let's see what we have. We have the independent auditor's report. We've got the same introductory, management's responsibility and auditor's responsibility paragraphs as in the standard unqualified audit report. And only the last sentence of the auditor's responsibility paragraph will be modified. And it would say that we believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for our qualified audit opinion. So we just insert the term qualified. Then just after that, we have the explanatory paragraph, the basis of the qualified opinion, in other words. Well, the company is excluded from property and debt in the accompanying balance sheet certain lease obligations, then our opinion should be capitalized conform with accounting principles generally accepted in the United States of America. If these lease obligations were capitalized, property would be increased by 4.6 million, long-term debt by 4.2 million, and retained earnings by 400,000 as of December 31st, and net income and EPS would be increased by 400,000 and $1.75 respectively for the year that ended. Well, obviously we've given the client a chance to fix this, but they didn't. How would you like to investigate this client? I'm sorry, how would you like to invest in this client once you investigated and found this out? I don't think so. This is not only a very stubborn client, since they wouldn't make this correction, they're also a very dumb, because this increased property by 4.6 million. Okay, long-term debt went up by less. Obviously, retained earnings went up, EPS went up, so mostly good things coming from this. I don't get it. Oh well. Steadfastly refuse, they'll get what's coming to them. So here's the qualified opinion. So in our opinion, except for the effects, the matter describing the basis for qualified opinion paragraph, the financial statements referred to above present fairly, the remainders the same as in the standard unqualified audit opinion. So except for this one thing wrong, we think everything else is okay. Any questions about that? Okay. Let's come back here to the notes. Okay, by the way, we just did number 1 here, but just look in the qualified report only, the opinion section is qualified. And again, the term except for is used. The auditor's responsibility section is not qualified or changed in any other way because an effective audit occurred. And neither is the introductory paragraph or the management's responsibility section modified. Now, in number 2, in the adverse opinion, the opinion section states the auditor believes financial statements are not fairly stated in accordance with GAAP. We'll see it next. It's really bad. And before I go there, look at number 3. In both reports, a section for the basis of the qualified or adverse opinion is added. Again, it precedes the opinion section. This way, the reader knows what's wrong by the time they get down the opinion section, and it's not clean. Let's go here to the book. Let's look at figure 311, adverse opinion due to non-GAAP. This time we've got the worst case scenario. This auditor decided that this problem is highly or pervasively material. We'll see the same thing is wrong in the basis for the adverse opinion. So my guess is that this auditor has looked and has seen that this client in figure 311 is smaller overall. Therefore, these numbers are a bigger chunk of the client. So more material. So let's see, we've got the same introductory, management's responsibility and auditor's responsibility paragraphs. It's in the standard unqualified auditor's report. Only the last section of the auditor's responsibility section we modified, we see next. So it says, we believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for our adverse audit opinion. So we insert the term adverse. Then the basis for the adverse opinion, same thing. Now the adverse opinion. So in our opinion, because of the significance of the matter describing the basis for adverse opinion paragraph, the financial statements referred to above do not present fairly. The financial position of Ajax Company as of December 31st or the results of its operations and its cash flows for the year that ended. So that is really bad. We think that you cannot rely on these financial statements. Well, we don't want to invest in that company. And also, if this were a publicly traded company, the SEC is not going to be pleased. Again, they will say to this client, clean up your act, get another audit, and get something better than an adverse opinion. If you don't, by whatever deadline we give you, well, we're going to list your securities. By the time most companies get to that, they're on their way out anyway. So you don't have to worry, I guess we'd say. I've only seen a couple of these in practice, and I remember one was years ago for a paid telephone company in Tampa. Well, how long has it been since anyone's used a payphone? Yeah, we have cell phones. A long time ago, people had to rely on payphones. So this company had not made the transition to cell phones. Its business model was just going way downhill, obviously. So they did get an adverse opinion. They went out of business shortly thereafter. So I think they had so many other problems that they just didn't worry about this adverse opinion. They were going out. Any questions there? Righty? Now, if we look at number 4 here, a qualified report is also issued if there's inadequate disclosure. Again, we said earlier, how often in practice? Not very, because clients will fix it. Otherwise, you get something bad in the way of an audit opinion. Or if not, all the required financial statements are present, like we said. On incomplete presentation, GAAP says they must all be there. An adverse opinion is not applicable to these special precautions from GAAP, although it could be used in rare cases with inadequate disclosure. That would be if the auditor feels that the client is trying to mislead readers. Not going to happen. Also, the statement of cash flows omitted, which is usually the only one that would be, well, the auditor should not mention cash flows in the audit report except to qualify it. So let me just see if we have one of these in the book as an example. And the answer is no, we don't. Anyway, it would look just like the qualified report that we saw earlier for the departure. Just like that. Yeah, I hope you never see one of these in practice, because if you do, you have a hold of a very dumb and very stubborn client. Don't invest in them. Number 6, here's a special case. Well, let's say if the auditor agrees with the departure from GAAP due to special circumstances, may issue a clean opinion under Rule 203 of the AICPA's Code of Professional Conduct, but must add basis of accounting section after the opinion section. The opinion section will be unqualified, but will reference that basis of accounting used. And when you have a chance, you can glance at Exhibit 25-8. We'll cover that toward the end of the course. So you don't have to know what's in it for now, but just glance at and you'll see this so-called Rule 203 report. The auditor agrees with a departure from GAAP. Most commonly, it's because of some other basis of accounting that the client's using, like the cash basis or the income tax basis or IFRS. Those are okay. Anyway, as long as there is some major justification for this departure from GAAP, fine, we can give a clean opinion. Well, then number 6. Another little aside. Remember, the auditor gives the client a chance to correct the departures from GAAP before issuing a qualified or adverse opinion. Well, generally, the client gives the auditor the adjusted trial balance. And the account balances on this trial balance are called book values. These are what are on the client's books. So, unaudited, maybe not right. And the auditor will then gather evidence to determine the appropriate balance for each account, which is the audited value, the correct one. And if there's a difference between the book and audited values, the auditor will propose an audit adjustment to the book value. And clients may or may not choose to record audit adjustments. And if they don't record material adjustments, then the financials will not be presented in accordance with GAAP, and the auditor will not be able to give a clean opinion. So let's say the auditor here has audited cash. Let me stop sharing for just a moment here. Good. Okay. So let's say that we've gone through, we've audited cash. For cash, we've seen the client has a book value of $900,000. We went through and we audited cash. So we have an audited value oops, it's not doing so well on ink. $850,000. So to obtain that, by the way, audit evidence for cash is both count any currency the client has on hand and will confirm all cash on deposit with the bank. So is this the correct cash balance or not? We send a special statement to the bank. It's returned directly to the auditor. Very reliable evidence. So we can audit cash quite completely. Which, by the way, do you think we want to do that? Oh, yes. First thing on the balance sheet, most liquid asset. So it can be stolen. So it looks like the book value for cash is overstated by 100,000. So now, as an auditor, we propose an audit adjustment. So just move this a little bit so you can see everything here. Screen. So again, we propose an audit adjustment of $50,000. Would you say debit or credit cash? You betcha, credit. $50,000. That will reduce that cash balance. So now we strongly advise client to make that. We tell them if they don't, they're not going to get a clean opinion. Yes. Debit, most likely retained earnings. You bet. So you can make this on adjustment if you would like. Probably a debit to retained earnings and a credit to cash. There could be some other accounts involved with debit that we have to know some details. All right. We're saying to the client, you can make that if you like. We strongly advise you to. If you don't, you won't get a clean opinion. So what will virtually every client do? They'll make it. Yep. If they don't, again, they're really dumb and really stubborn. No thank you to investing in them. Journal entry there on the screen. Right, go back here. Share the screen again. Now, let's talk about lack of independence. It's really short. So in order to do that, let me go back page 67. Look at that in this chart. Auditors not independent. We see only one choice. Disclaimer regardless of materiality. So either we are independent or we are not. For example, we might own only one share of stock at a client. Well, we could say on the surface that that one share is clearly immaterial out of millions of shares outstanding. So, seems like that's the way it should be. But in reality, the ACC Code of Professional Conduct, one of those two background chapters it's in, will say, no, that one share of stock you own, the appearance is such that you are not independent. So, count on any stock at all in a client. Best thing to do, as we said last week, own a mutual fund. And shares of a mutual fund, if your client is one of the many clients that this mutual fund owns shares in, that's not a material investment on the part of the mutual fund. If our client goes bankrupt, it's not going to impact the mutual fund to any great extent. Plus, the mutual fund owns the shares. They can vote. You can't because you don't drive. So that's okay. So let's say that we have an auditor with very poor quality control. They did not detect that they were not independent. Well, that's the only time this thing would show up. But if they're not independent, let's see what this report is going to look like. It's really short. So, a little bit of a difference in formatting between the ebook and my printed version. Just find one I'm looking for. We have an audit report here. There we go. Okay, it is page 66. My input 66 manually didn't come up. Okay. So disclaimer due to lack of independence. We issue a disclaimer that says we cannot give an opinion. So we are not independent with respect to HomeDecor's.com Inc. And the accompanying balance sheet as of December 31st and related statements of income, routine earnings, and cash flows for the year that ended were not audited by us. Accordingly, we do not express an opinion on them. There's a little note there that when the auditor lacks independence, no report titles included. So again, we hope we never, ever, ever see one of these in practice. I don't think we will. If we did, that's an auditor with really poor quality control. Any questions on it? Okay. Well, this next section, unqualified audit reports with emphasis of matter, explanatory paragraph, are modified work. So under the following circumstances, and we'll see them listed in the book, the auditor can issue a clean opinion, but must modify some of the wording of the standard unqualified audit report. And generally, this will involve adding an explanatory paragraph after the opinion section. Note that placement, since the opinion section is not modified. Again, the auditor will not change the report due to any of these conditions unless material. Well, the first thing, we talked earlier about that lack of consistency and applying accounting principles. There's been a change to accounting principle. That's the first condition here. Nothing's wrong, but we have to highlight this fact to readers. I'll show you how we do it. So lack of consistency in applying GAAP. Well, here the client has changed accounting principles. And the auditor will modify the report by adding an explanatory paragraph after the opinion section. Only consistency is affected, not if comparability is affected. I'll show you that in the book in just a moment. And the client must also disclose lack of consistency in a footnote, otherwise disclosure is inadequate. And the auditor must also agree with the reason for the change, otherwise treat it like a departure from GAAP. So here in the book on page 55, so this lack of consistent application of GAAP sounds bad at first, but it's not in most circumstances. So let's look here, consistency versus comparability. Well, the auditor must be able to distinguish between changes that affect consistency and those that may affect comparability, but do not affect consistency. And the following are examples of changes that affect consistency and therefore require an explanatory paragraph if they're material. These are all changes of accounting principle. We must bring them out in the audit report. So one is a change in accounting principles, such as a change from FIFO to LIFO. Again, some auditors may not agree with that because LIFO is not in accordance with IFRS. Well, it's the other way around, the client is changing. Then changes in reporting entities, such as the inclusion of an additional company in combined financial statements. So this client has purchased another company. They're now including them in their financial statements. In that case, it's like a change of accounting principle. And number three, correction of errors involving principles. By changing from an accounting principle that is not generally acceptable to one that is generally acceptable, including correction of the resulting error. So that's a change from non-GAAP to GAAP. Client finally wised up. Let's see what this looks like in the report. I go down the page here, figure 3.5. Explanatory paragraph because change of accounting principle. So the same paragraphs in the standard unqualified audit report. That doesn't change. We just tack on an explanatory paragraph at the end. It will be at the end, after the opinion paragraph, that is, because it doesn't change the opinion paragraph. This way, the reader doesn't need to know what's wrong as they read down through the opinion paragraph. So, as discussed in Note 8 to the financial statements, the company changed the method of computing depreciation in 2016. Our opinion is not modified with respect to this matter. In other words, we agree with it. It's okay. There's been some talk in the past about removing the need to do this in the audit report, but that hasn't passed yet. I wish it would one day, just give us a little bit less to study, but right now it's thought that as an auditor, we need to warn readers about this change. This way they know there's been a change in accounting numbers between last year and this year. Maybe one day that'll go. All right. Now, I mentioned there's some reasons why comparability might be affected, but consistency isn't. So change that affect comparability, but not consistency, and therefore need not be a part of the audit report. So does not affect consistency. That's okay. There's no change of accounting principle. Will affect comparability where there has been a change of accounting principle. So change in comparability, yes, bring it out in the report. I'm sorry, pardon me. Change in comparability, no, do not bring it out in the report. A change that affects consistency, yes, bring it out in the audit report because again, there's been a change of accounting principle. So what we do not include in the audit report, change in an estimate, such as decrease in life and asset for depreciation purposes. So there's no change of accounting principle there. Now, if we had to change this and change the audit report that is, to bring this out, how often do you think we would be doing it? All the time. All the time. Because this happens all the time, or a change in the number of years useful life for depreciation purposes happens all the time. And quite frankly, how many financial statement readers care? They don't. Number 2, error corrections not involving principles, such as previous year's mathematical error. Again, if we had to do this, how often would we be bringing out the audit report? Constant. Plus, how many financial statement readers care? They don't. Then variations in format and presentation of financial information. Cosmetic changes, we'd be doing that all the time too, plus nobody cares. And number 4, changes because substantially different transactions or events, such as new endeavors and R&D or the sale of a subsidiary. Again, we might be doing that all the time and nobody cares. So any questions about any of that? All right. So back here on the handout. Second thing that we have. Substantial doubt, there and B, about the client's ability to continue as going concern. So they might cease operations. And the auditor must assess whether he or she believes the client can survive for a period of 1 year past the date of the financial statements. And the auditor is not a predictor of the future, but will look for some signs of trouble. I won't test you on them, but things like recurring operating losses, a cash shortage, inability to pay obligations that come due, all bad things. Again, the auditor will modify the report by adding an explanatory paragraph after the opinion section, and the client must have footnote disclosure. Alternatively, the auditor may issue a disclaimer of opinion instead. It's rare, but if it disclaimers issued, the explanatory paragraph would then appear before the opinion section because the latter is qualified. So let's see what this looks like in the book. So here in figure 3.6, explanatory paragraph because substantial doubt about going concern. So the very same clean audit opinion, except now we have this explanatory paragraph at the end. Well, the accompanying financial statements have been prepared assuming the Fairfax company will continue as a going concern. As discussed in note 11 to the financial statements, Fairfax company has suffered recurring losses from operations, bad sign, and has a net capital deficiency, another bad sign, that raised substantial doubt about the company's ability to continue as a going concern. Management's plans regarding these matters are also described in footnote 11, and they must be footnoted. The financial statements do not include any adjustments that might result from the outcome of this uncertainty. And they say that because if it is certain the client is going to go under, cease operations, are historical costs appropriate any longer? They're actually not. I don't know if you remember that from financial accounting, but instead liquidation values are. So just how much creditors can get out of this client. Yeah, in the past couple of years, a lot of brick and mortar retailers have gotten this because they've had substantial doubt about going concern and they have not continued in operation. A lot haven't. So auditors certainly do issue these. Any questions there? Okay. Back here in the notes. We mentioned this one before, Rule 203 report. That's that justified departure from GAAP. We'll study it in chapter 25. And just for now, remember the auditor will modify the report by adding an explanatory paragraph, which is actually a section describing that base of accounting after the opinion section. And the client must also have footnote disclosure. So something like the cash basis. Well, then D, emphasis of any matter the auditor desires. And the auditor will modify the report by adding an explanatory paragraph after the opinion section again. But the client must have footnote disclosure. I'm sorry, the client need not have footnote disclosure. And the auditor should not use any language in the opinion section to refer the explanatory paragraph. This is a matter is always optional. The Auditing Standards Board suggests the auditor emphasize such matters as large numbers of related party transactions, material uncertainties, anything that doesn't look quite right, needs some further explanation. So this is always up to the auditor. There's not an example of one of these in your book. Sometimes this happens. There's another auditor, like auditing a subsidiary of the company. Well, we need to consider their report too. So let's see what we do. Reports involving other auditors. So here another auditor audited a segment of the client. And there are three possible reports to issue. One is a standard unqualified audit report, which makes no reference to the other auditor. And that's applicable when the principal auditor, the one that issues the main audit report for the client, is willing to take complete responsibility for the other auditor's work, or if the other auditor audited an immaterial portion of the financial statements. And the other auditor's report should not contain material modification, or qualification rather. If it does, we must qualify. So how many auditors do you think will take complete responsibility for another auditor's work? I hope not. Yeah, if they want to, they could, but not too good. Instead, what usually happens if they don't mention the other auditor is that that other auditor audited an immaterial portion of the financials, not big enough to make a difference. Well, here's a second alternative. It's the most common one by far. A standard unqualified audit report, which has modified wording to refer to the other auditor. And that's often called a modified wording report. There's an example on page 58. I'm not too worried about it. We just refer to the other auditor all the way through. And we also give some magnitude of dollars as to what the other auditor audited. So often called a modified wording report again. And that's applicable when the principal auditor wishes to share responsibility with the other auditor. Shared responsibility report, sometimes called, as we saw. Or here's another thing. The other auditor's report should not contain a material qualification because if it does, we must qualify too. Then finally, a third alternative. Qualify the audit report. And that's applicable when the principal auditor does not wish to assume any responsibility for the other auditor's work. Usually that's if the principal auditor is not satisfied with the quality of the other auditor's work. And it's also applicable if there's material qualification in the other auditor's report. That sometimes happens. Any questions there? Okay, not too far from being over. Have some other notes here. Well, first, if there's more than one condition requiring modification in the standard unqualified auditor's report, the auditor should exhaustively enumerate these conditions in the audit report. There should be one separate explanatory paragraph for each condition, and there should be a separate except qualification for each condition, which requires qualification. However, if the auditor is not independent, only issue that really short disclaimer we saw on page 61 or 65 rather, because that's all we can issue. But otherwise, exhaustively bring everything out for every year of financial statements presented. Lay it all out on the line, total transparency, and you'll be okay. Then B, negative assurance is not permissible in an audit report. Let me also just add a little note here. It's also called limited assurance. Negative assurance says that nothing came to our attention to show that the financial statements were not fairly stated in accordance with GAAP in all material respects. An audit provides positive assurance instead. So that audit opinion that says we believe the financials are okay is called positive assurance. We'll see a few situations later in the course where we can use negative assurance, but none in regard to an audit. So for negative assurance, for us to say we found nothing to indicate something's wrong, we would have to do no work. We can always say that. So we can only use it in a very few places. We'll see why. Then third, a piecemeal opinion is not applicable. It's not permissible. A piecemeal opinion gives different opinions on the different financial statements, like a clean opinion on the balance sheet and a qualified opinion on the income statement. Well, instead the auditor gives one opinion on the financial statements taken as a whole. They all tie together, which is why they don't get different opinions at any time. Indeed, remember that you can access companies' SEC filings through the EDGAR database on the internet. And the annual financials, which are part of Form 10K, that's one that the company files once per year. It will contain the auditor's report. Then, under Section 404 of the Sarbanes-Oxley Act, management must issue a report which attests that they are responsible for internal control, as well as for their assessment of the effectiveness of internal control. Is it okay or does it need to be spruced up? Well, the auditor must attest to management's internal control report. And this means the auditor will integrate the audit of the financial statements with an audit of internal control for SEC companies, not for privately held ones, only for publicly traded ones. And the auditor may issue the internal control audit report separately from the financial statement audit report. It's on page 53, or it may be combined with the audit report on the financials. We'll study more about it in chapter 10, but for now, just know it exists. Just read through it. I won't test you on it yet, certainly. So that happened 3 years after Sarbanes-Oxley passed. So suddenly we had 2 audits in one about the financials, one about internal control. What do you think happened to the overall cost? Went way up, 2 audits in one. Plus, suddenly there was a lot more risk attached to that. Liability insurance went up. You also had to have more experienced professionals working on SEC engagements. They're high risk. So definitely audit costs went up. And finally, auditors must read the other information contained in an Academy's annual report to make sure it's consistent with the financials. However, auditors are not required to read information contained in websites, even though the financials may be posted there. That's because website information is not considered to be documents under GAAS. That loophole may be addressed in future authoritative guidance. I admit it sounds strange. That takes care of everything here in chapter 3. Any questions? By the way, this here will help you out on homework, just summarizes the placement of the explanatory paragraphs. So that way you can always get those right. Very important, because on CPA exam, one common type of simulation question, it's not really an essay question, but simulation questions are simulating some tasks auditors do. Well, one common simulation question is that they will give you various paragraphs in the audit report in random order, and then you need to drag and drop them to the correct placement. So that's why I keep emphasizing this placement of that explanatory paragraph. So, any questions or anything? Again, I know that I've given you a lot of material here in the chapter. The most out of any chapter of the book, as I said, but that's okay. Got it over with. But there just is a lot of material to audit reports. And there's no easy way to teach it. Just have suffered through. But, you know, accounting's a lot about suffering through various things, because if we didn't have as much suffering, what would a lot of people want to do? Major in accounting, that's right, become accountants. What an excellent way of putting it. We're willing sufferers because we want more money and more prestige, more respect. Oh, we're really respected. Greater opportunities out there. So yeah, we're okay. And don't worry, as we get further in the course, we learn a whole lot about auditing and things get much more understandable. They truly do. I don't think I'll be too good. All right. Well, you have a good week, and I'll see you back a week from tonight. Take care. All righty. Good night, Daphne. You take care and let me know if you have any questions, okay? All right. Good night. Bye-bye.